are huge because earning even 10% on 1 million is huge. They earn 22%, and earning 20% of 100,000. It's not that much efforts are required. So that's why you see the bigger company, their profit is just 2%, net profit 2%, 3%, 4%. Look at that. Look at, their sales are in billions of dollars, $10 billion, $20 billion. Look at the bank's profits. Their sales, if you see their income statement, their sales are in billions of dollars, and their income is, you can see that percentage, 2%, 3%, 4%, 5%. It's because of that, due to the size, right? So that is the biggest problem for residual income. Now, what we have learned up till now is the performance measurement of departmental performance measures. And now we talk about the production department efficiency measures or performance measures. Because this is a managerial accounting, and managerial accounting makes sense most of the time inside the factory. So your performance is evaluated based on, if you are in head office, your performance is based on the cost center, the responsibility center. If you are in cost center, then you are evaluated based on according to the methods over there. But we talked about ROI and residual. If you see that your department is small and other department is huge, then a residual method doesn't make sense because of the issue of the size. Then go forward with the ROI method, right? And what if you are in the factory? How your performance are going to be evaluated? So we are evaluated based on delivery time cycle, throughput time, manufacturing cycle efficiency. So we will see different formulas of there, and these formula make sense as well. So the delivery performance measures, it depends on the whole process. So when the order is received, right? So it's not like that at the time, the order is received, you quickly go for processing it. Maybe you give some time for the customers, maybe he want to change the order or something, or if he confirmed the order, even the order is sent in a queue, and because of production hours going on. So when order received, there's a wait time here, which is good for the company as well, for the customer as well. Plus too much time, wait time is not good, right? And then production start. Process time, you convert raw material into finished goods. Inspection time, you hire some supervisor who is inspecting whether every product is like of the standard, quality check control is there, right? Move time, what do we mean by move? You move from factory to warehouse for packaging, or it's like that, right? So product is now made in cottons, and cottons are now lifted to the warehouse. Queue time, and you paste the orders. Okay, now this is for Mr. Jamal, sent to the Pakistan. This is David, sent to the Moscow. This is Sipade, they sent to the Shanghai. Chandra, sent to the Korea. So what is my time? What is my number is 4. So after sending all these 3, and then my time will come that I receive the order. So throughput time is the addition of all process time, inspection time, move time, queue time, right? And if you add wait time as well, this all is called delivery cycle time, right? So process time is the only value added time here, right? Inspection time, normally it is done by through computers, and we have lasers technologies and all stuff. Moving time, conveyor belts, everything is moving. Queue time, robots are doing that. Look, you have seen the Alibaba and Amazon, they are queuing the orders, like robots are doing that, right? So most valuable time now left, which involve humans, is the process time, right? The crane is coming and putting raw material over there. The plant is running. shifts are doing, people are coming, right? Supervisor over there to watch over the process, right? If anything happen, if plant makes some noise, you ask electrical engineer or mechanical engineer to come and fix this. This is all under process time. The only valuable component that you see here on the basis of evaluation or performance measurement is the process time, because other times they are standard one, and or you already gone to the minimum of that one, right? So let's talk about the measures here. So the value added time divided by manufacturing cycle time, we call this manufacturing cycle efficiency, right? So process time or value added time divided by the manufacturing time. So here we go. A quick check. So what is the throughput time? So recall your memories right now. What is the throughput time? Throughput, processing, queuing, inspection, and move. How much is that? 0.2 days, 0.4, 0.6, 1.1, 4, and here is 10.4. Answer going to be 10.4. Understand? If not, then please see the answer here. Throughput time is equal to
time and queue time,
right? Throughput time is equal to process time plus inspection plus move plus queue time. So even if you find out these time, you can still see that where we need to improve. So all these are within the day, within the day, within the day. So this takes 3 days, and this takes queue time takes 9.3 days. So in queue time, then there is a chance for damages or product obsolescence or something like expiry, right? Because 9.3 days, the goods who belongs to the customer still remain at your premises. So you need to work here, plus the wait time as well. It's too much. Or maybe you are making heavy industry stuff, so that take more time than it makes sense. Now, what is manufacturing cycle efficiency? Process time divided by all the time. Delivery time or manufacturing cycle efficiency. What is that? 0.2 divided by 10 point. What's the
Sure.
0.2 divided
5.1.
10 point? No. How you calculate the 5.1?
3 plus 0.4, 0.2, 0.5, 5. Oh, it's actually 4.1. Never mind.
It's not like that. The manufacturing, so total time is basically, oh, I think we forgot. What is manufacturing cycle? It is the throughput time, because
The
that
same
is
as the
used
previous.
for manufacturing, right? That is used for manufacturing. So that is that you are dividing with the delivery cycle. The goods are delivered to the, no. This is the value, this is the throughput time basically is equal to manufacturing cycle time. That it takes time to convert into manufacturing, right?
Oh, okay. Okay.
It is 1.9. 0.2 divided by 10.4, we just calculated in our previous slide. Answer going to be 1.9%. Understand?
Yes.
What is delivery time cycle? Add all these stuff, 13.4, right? DCT. Now we are, I think, the last concept of this chapter. So what we have learned up till now, two methods, ROI and residual income. We talked about their pros and cons. What are the disadvantages of ROI? That some profitable projects may be may be rejected. The profitable options may be rejected. Plus, it acts as a barrier for innovation uh, in the organization. And what is the drawback for RI, residual income? That you cannot compare it with different sizes, right? There is another method, we call this balanced scorecard, in which, and mostly this is developed by, it varies from organization to organization, in which we divide all the activities not just based on one thing, we based on all the stuff. Balanced scorecard, balanced, so it means my intake, what happened, how much I am contributing to HR, how much I am contributing towards the sales, how much my actions contributing towards the organization's sustainability. So you add that score and you compare with the standard one. If you are above average or average, you will be retained in the organization. If you are below average, you will be given warnings. If you consistently below the warnings, you would be given the resignation letter, right? So it's not like that your performance measures is just measuring through the delivery time cycle in the production department or the according to the profit, because profit is not in my hand, but how much I contributed towards the profit, that makes sense. So all the profit doesn't belong to me, right? There are other efforts. So all the sales doesn't belong to the sales department. If quality is not good, then how marketing department will market on the basis of what? If the marketing department is shouting that, oh, we have a good quality stuff and all the stuff, who make that good quality stuff? Is the production department. So don't take all the credits of good quality. Don't take, please, marketing department, don't take that high quality slogan and cash on the basis of the quality by yourself. We performed well because we, and the HR department will say that, what the hell you are talking about? We hired smart people, so that's why the sale is increasing. People had nothing to do with the quality because we hired good people who make good quality stuff, and good quality stuff is cashed by marketing department and sales are increasing, right? So there is a constant war here. So all those methods we have discussed here, these are questionable, right? So if I am the boss here and I'm going to be evaluated, if I claim that all the sales increase is because of me, then I'm wrong. Because the good workers, they produce good stuff, defect free stuff. The marketing department, they outperform their services, their duties, right? The business process was quite right. The IT department, they did well. They handled the software very well. And I cannot claim that it is because